Here are 101 facts about Wall Street that you probably don't know, and honestly, some of them they'd prefer you didn't. Number 1. Wall Street is named after an actual wall. In 1653, Dutch colonists built a 12-foot wooden barricade to keep out the British and Native Americans. The wall came down in 1699, but the name stuck, and so did the tradition of keeping people out of where the money is. Number 2. The New York Stock Exchange started under a tree. Literally. In 1792, 24 stockbrokers signed the Buttonwood Agreement beneath a buttonwood tree at 68 Wall Street, agreeing to trade only with each other and charge a minimum commission. It was basically the first Wall Street cartel, and they didn't even try to hide it. Number 3. Wall Street has its own private army. The NYSE employs one of the largest private security forces in the country, and the surrounding area is one of the most surveilled places on Earth, more cameras per square foot than Times Square. Apparently, money needs bodyguards. Number 4. The famous Charging Bull statue was actually placed illegally. Artist Arturo Di Modica dropped the 7,100-pound bronze sculpture in front of the NYSE at 1 a.m. on the 15th of December 1989, without any permits. Police removed it within hours, but public outcry was so massive that the city gave it a permanent spot 2 blocks away. Guerrilla art for the win. Number 5. The stock market has been manipulated since literally the first day it existed. In 1791, Treasury Secretary Alexander Hamilton created the first U.S. government bonds, and within months, speculators had already figured out how to artificially inflate prices. Some things never change, and that was just the warm-up. Number 6. The first stock market crash in American history happened in 1792, the same year the stock market was created. A speculator named William Dewar tried to corner the market on bank stocks, failed spectacularly, and caused a panic that wiped out investors across the country. He spent the rest of his life in debtor's prison. Wall Street speedrun? Any percent. Number 7. The term bear market comes from an old proverb about selling a bear skin before catching the bear. Speculators who sold shares they didn't own, hoping prices would fall, were called bearskin jobbers. Eventually, it got shortened to bears. The term bull came later, simply because bulls and bears fight. That's literally the whole reason. Number 8. In 1869, 2 guys tried to corner the entire U.S. gold market. Jay Gould and James Fisk bought so much gold they drove prices through the roof, until the government dumped $4 million in gold reserves to crash the price. The 24th of September 1869 became known as Black Friday, and hundreds of businesses collapsed overnight. Gould had already quietly sold his position. He made millions while everyone else burned. Number 9. Wall Street bankers used to literally throw money out the window. During the Panic of 1907, J.P. Morgan summoned the country's top financiers to his private library and locked them inside until they agreed to bail out the banking system with their own money. One banker famously said, "We were told the alternative was financial collapse." Morgan basically held capitalism hostage in his living room. Number 10. The Panic of 1907 was so bad that it led to the creation of the Federal Reserve in 1913. Before that, there was no central bank, no lender of last resort, and no safety net. Just vibes and prayers, basically. Number 11. The Roaring Twenties weren't just about jazz and flappers, they were about rampant market manipulation. Pools of wealthy investors would secretly buy stocks, pump up the price through fake trades with each other, plant stories in newspapers, and then dump their shares on unsuspecting retail investors. It was completely legal. Wild times. Number 12. Before the 1929 crash, you could buy stocks with only 10% down. The other 90%? Borrowed money. This was called buying on margin, and it meant that when prices fell, everyone got margin calls at once, forcing them to sell, which made prices fall more, which triggered more margin calls. It was a doom spiral with extra steps. Number 13. The 1929 crash didn't happen in one day. It happened over several. October 24 was Black Thursday. October 28 was Black Monday. October 29 was Black Tuesday. By November, the market had lost $30 billion, roughly $500 billion in today's money. The entire GDP of the United States was about $100 billion at the time. Number 14. The myth that bankers were jumping out of windows during the 1929 crash is mostly exaggerated. There were suicides, yes, but the reigning banker's image was largely created by newspapers hungry for dramatic stories. The real devastation was quieter and stretched over years as the Great Depression took hold. Number 15. After the crash, Congress held hearings that exposed just how rigged Wall Street had been. The Pecora Commission discovered that the head of National City Bank, the precursor to Citibank, had given himself interest-free loans from the bank's funds to cover his personal stock losses. He paid zero taxes in 1929 and 1930. The public was understandably furious. But here's where it gets interesting. Number 16. The Securities and Exchange Commission was created in 1934 to regulate Wall Street, and its first chairman was Joseph Kennedy, one of the biggest stock manipulators of the 1920 seconds. President Roosevelt's logic? Set a thief to catch a thief. Kennedy actually did a decent job, which might be the most surprising plot twist in financial history. Number 17. The Glass-Steagall Act of 1933 separated commercial banks from investment banks for over 60 years. The idea was simple. The banks holding grandma's savings shouldn't be allowed to gamble with it. It was repealed in 1999. Guess what happened 9 years later? Number 18. Wall Street has its own superstitions. Traders believe certain things bring bad luck. Saying the word down before trading opens, wearing green, or eating before the closing bell. Some traders will only sit in the same chair or enter through the same door. It's basically astrology for people who mock astrology. Number 19. The NYSE trading floor used to be absolutely chaotic, literally thousands of people screaming and waving pieces of paper. Today, fewer than 400 traders work on the floor, and most of them are there for the cameras. Over 80% of trades happen electronically, often in fractions of a second. Number 20. Speaking of fast, high-frequency trading firms pay millions of dollars to place their servers physically closer to exchange computers. A 1 millisecond advantage can be worth $100 million per year. They've laid private fiber optic cables in perfectly straight lines across the country, sometimes through mountains, just to shave off microseconds. Number 21. In 2010, the stock market crashed 1,000 points in 5 minutes, wiping out $1 trillion in value, and then recovered almost completely within 20 minutes. It was called the flash crash, and for years no one could explain what happened. Turns out a single trader in London spoofed the market from his parents' house. He made about $40 million. We'll get to him later. Number 22. Dark pools sound like something from a fantasy novel, but they're real private exchanges where massive stock trades happen without anyone seeing them until after the fact. They were created to let institutions move large positions without tipping off the market. As of 2024, roughly 40% of all stock trades happen in dark pools. Transparency is so last century. Number 23. Wall Street has its own zip code, 10005. It also has its own weather. The canyon of skyscrapers creates wind tunnels so intense that on bad days you can barely walk. Traders in the 1800s used to judge the market's mood by how hard the wind was blowing. I'm not kidding. Number 24. The closing bell at the NYSE isn't automatic. Someone has to actually ring it. Ringing the bell has become such a PR opportunity that companies pay up to $50,000 for the privilege. Celebrities, athletes and executives line up for the honor of making noise for 6 seconds. Number 25. The fastest market crash in history lasted exactly 36 minutes. On the 19th of October 1987, Black Monday, the Dow Jones dropped 22.6% in a single day. That's still the largest one-day percentage decline ever. What caused it? A combination of computerized trading, portfolio insurance strategies, and good old-fashioned panic. Now let's talk about the criminals. Number 26. Bernie Madoff ran the largest Ponzi scheme in history, $65 billion in fake investments. For 17 years, he told clients he was generating consistent 10–12% returns. In reality, he was just using new investors' money to pay old investors. When the 2008 crisis hit, everyone wanted their money back at once, and the whole thing collapsed like a house of cards in a hurricane. Number 27. Madoff was so trusted that he was the former chairman of Nasdaq. He sat on SEC advisory committees. People begged to invest with him. When whistleblower Harry Markopoulos told the SEC that Madoff's returns were mathematically impossible, they investigated and found nothing 3 separate times. Markopoulos literally titled his report, "The world's largest hedge fund is a fraud," and the SEC still didn't act. Number 28. The total amount stolen by Madoff exceeded the GDP of most countries. Victims included Steven Spielberg, Kevin Bacon, Elie Wiesel's foundation, and hundreds of charities. Some people lost everything. Madoff died in federal prison in 2021, aged 82. His 2 sons are also dead, one from cancer, one by suicide. Number 29. Jordan Belfort, the real Wolf of Wall Street, defrauded investors out of approximately $200 million through pump-and-dump schemes in the 1,990 seconds. He served 22 months in prison and was ordered to pay $110 million in restitution. As of 2024, he's paid back about $14 million. The rest? He makes money giving motivational speeches about sales. You can't make this up. Number 30. Belfort's firm, Stratton Oakmont, was so corrupt that Leonardo DiCaprio actually downplayed the debauchery for the movie. The real office had dwarf-tossing competitions, a live chimpanzee in a diaper, and employees were allegedly paid in cash and drugs. Belfort himself has admitted the movie was maybe 80% accurate, which is wild considering what's in the movie. Number 31. Ivan Boesky was the original insider trading villain. In the 1,980 seconds, he made hundreds of millions by getting illegal tips about upcoming corporate takeovers. His catchphrase, "Greed is good," which Oliver Stone later gave to Gordon Gekko in Wall Street. When Boesky got caught, he cooperated with the feds and helped take down an entire network of corrupt financiers. Snitches get reduced sentences. Number 32. Michael Milken was the junk bond king who revolutionized corporate finance in the 1,980 seconds and was later convicted of securities fraud. He paid $600 million in fines, served 22 months in prison, and was banned from the securities industry for life. In 2020, Donald Trump gave him a full pardon. Milken is now worth approximately $6 billion. Number 33. Raj Rajaratnam ran the largest insider trading scheme involving hedge funds. He made over $60 million trading on illegal tips from corporate insiders, including executives at Goldman Sachs, Intel, and McKinsey. He was caught because the FBI wiretapped his phone, the first time that technique had been used in an insider trading case. He's currently serving an 11-year sentence. Number 34. Martha Stewart went to prison for 5 months, not for insider trading exactly, but for lying to investigators about why she sold her ImClone stock. The trade itself saved her about $45,000, pocket change for a billionaire. The lie cost her $195 million in market value losses for her own company, and 5 months in a West Virginia federal prison camp nicknamed Camp Cupcake. Number 35. SAC Capital, run by Stephen A. Cohen, was a hedge fund so riddled with insider trading that the entire firm pleaded guilty to securities fraud. 8 employees were convicted of insider trading. Cohen himself was never criminally charged, but he was banned from managing outside money for 2 years and paid $1.8 billion in fines. He now owns the New York Mets. Crime doesn't pay unless it totally does. The schemes get more creative from here. Number 36. In 1983, a pizza delivery man in Louisville, Kentucky, made $20 million in one afternoon by trading on insider information about a corporate takeover. Barry Switzer, yes, the football coach, overheard the tip while at a track meet. He didn't even know what insider trading was. Neither did the pizza guy. Both got caught. Number 37. Enron was once the seventh largest company in America with a stock price of $90. It was also a complete fraud. Executives hid billions in debt through fake partnerships and manipulated California's energy market for profit. When the truth came out in 2001, the stock dropped to $0.26. 20,000 employees lost their jobs, and many lost their entire retirement savings. Number 38. Enron's accounting firm, Arthur Andersen, was convicted of obstruction of justice for shredding documents related to the fraud. The firm, which had existed since 1913 and employed 85,000 people, collapsed almost overnight. The conviction was later overturned by the Supreme Court, but by then Arthur Andersen was already dead. Sometimes the cover-up is worse than the crime. Number 39. WorldCom CEO Bernie Madoff committed an $11 billion accounting fraud, the largest in American history at the time, by inflating revenue and hiding expenses. He was sentenced to 25 years in prison. He died in 2020, shortly after being released due to failing health. His defense at trial? He claimed he didn't understand accounting. Judges love that one. Number 40. Tyco's CEO Dennis Kozlowski used company money to throw his wife a $2 million birthday party on a Mediterranean island, complete with Jimmy Buffett performing a vodka-dispensing replica of Michelangelo's David and Gladiators. He also bought a $6,000 shower curtain for the office. He went to prison for 8 years. Number 41. Remember the flash crash guy from his parents' house? His name is Navinder Singh Sarao, and he used a technique called spoofing, placing huge fake orders to manipulate prices, then cancelling them before they executed. He made $40 million over 5 years while trading in his bedroom in suburban London. He was extradited to the US and faced up to 380 years in prison. He got 1 year of house arrest because prosecutors said he was on the autism spectrum and had zero lifestyle to show for his gains. He basically just liked the game. Number 42. In 2012, a London whale trader at JP Morgan Chase named Bruno Ixil made such massive bets that his positions moved entire markets. When those bets went wrong, JP Morgan lost $6.2 billion. CEO Jamie Dimon first called it a tempest in a teapot. It was not a tempest in a teapot. Number 43. LIBOR, the interest rate that governed $350 trillion in global financial contracts, was manipulated by traders at major banks for years. They would text each other asking for favors. Can you set it higher today? It's my birthday. Billions of dollars in loans, mortgages and derivatives were priced based on numbers that traders were literally making up. Multiple banks paid billions in fines. Number 44. In 2008, Société Générale discovered that a single rogue trader, Jérôme Kerviel, had lost the bank 4 euros, 9 billion through unauthorized trades. Kerviel claimed his bosses knew what he was doing and looked the other way because he was making money. He went to prison. His bosses did not. Number 45. UBS lost $2.3 billion in 2011 because of unauthorized trading by Kweku Adoboli. He was sentenced to 7 years in prison and later deported to Ghana. He now works as a motivational speaker about, you guessed it, risk management. Let's talk about the big crashes. Number 46. The 2008 financial crisis was caused by banks packaging bad mortgages into securities, rating agencies giving those securities top grades, and everyone pretending houses would go up forever. When housing prices fell, the whole system collapsed. 5 of the 10 largest bankruptcies in American history happened in 2008. Number 47. Lehman Brothers was 158 years old when it filed for bankruptcy on the 15th of September 2008. With $639 billion in assets, it remains the largest bankruptcy in U.S. history. That weekend, Treasury Secretary Hank Paulson, Fed Chair Ben Bernanke, and the CEOs of every major bank gathered in a conference room to decide whether to save Lehman. They decided not to. Markets cratered globally. Number 48. AIG, the insurance giant, was bailed out with $182 billion in taxpayer money because it had insured billions of dollars worth of toxic mortgage securities through something called credit default swaps. If AIG had failed, it would have taken down Goldman Sachs, Deutsche Bank and others. Goldman alone got $12.9 billion of that bailout money. They paid it back. Eventually, number 49. During the 2008 crisis, Goldman Sachs converted from an investment bank to a bank holding company in one weekend, a process that normally takes months. Why? Because bank holding companies could access emergency Fed lending. Goldman, along with Morgan Stanley, basically changed their legal status to survive. Number 50. Bear Stearns collapsed so quickly that employees showed up to work on Monday thinking they had jobs and found out by lunchtime they were unemployed. JP Morgan bought the firm for $2 per share, down from $170 1 year earlier. The building alone was worth more than the purchase price. Here's where things get weird. Number 51. Wall Street has a fearless girl statue, the bronze figure staring down the charging bull. Here's the irony. It was commissioned by State Street Global Advisors, a $4 trillion asset manager, as an advertisement for one of their funds. Also, State Street later paid $5 million to settle claims that it was underpaying female executives. Marketing is complicated. Number 52. The New York Stock Exchange has a secret entrance used only by dignitaries and executives who don't want to be seen entering through the front. It's on a side street and leads directly to the executive elevator. The regular traders use a different entrance entirely. Number 53. There's a McDonald's inside Goldman Sachs headquarters. It serves thousands of employees and is one of the highest volume McDonald's locations in Manhattan. Billion-dollar deals are made by people who eat Big Macs at their desks. Number 54. JP Morgan Chase owns more gold than most countries, approximately 133 million ounces held in custody for clients. Their vault under One Chase Manhattan Plaza sits 80 feet below street level and holds more gold than Fort Knox. It's one of the largest gold depositories in the world. Number 55. Wall Street's most exclusive club is the Breakfast Club, informal gatherings of the most powerful executives who meet to share information and coordinate strategy. It's technically not insider trading if you're just talking. The SEC has never successfully prosecuted a Breakfast Club conversation. Number 56. The term dead cat bounce describes a brief recovery in stock prices during a decline. The logic? Even a dead cat will bounce if dropped from high enough. Wall Street is not known for its sensitivity. Number 57. Pump and dump schemes have moved to social media. In 2021, the SEC charged multiple individuals for coordinating stock purchases through Twitter and Discord, hyping up small-cap stocks, and then selling at the peak. The most famous was a scheme involving the stock symbol HMNY, the company behind MoviePass. Some promoters allegedly made millions. Number 58. GameStop's 2021 short squeeze was caused by Reddit users on R, divided by Wall Street bets coordinating to buy shares of a heavily shorted stock, squeezing hedge funds that had bet against it. Melvin Capital lost 53% of its value in January alone. The stock went from $20 to $483 in 3 weeks. Congressional hearings followed. Nobody went to jail. Number 59. During the GameStop saga, Robinhood restricted users from buying the stock, which appeared to protect the hedge funds losing billions. CEO Vlad Tenev was called to testify before Congress. His answer to most questions was a variation of, "When I was a boy in Bulgaria." The memes were merciless. Number 60. Wall Street has its own vocabulary for losing money. A bloodbath is a bad day. Getting your face ripped off is a really bad day. Blowing up means losing everything. And catching a falling knife is trying to buy during a crash and losing even more. Colourful language for colourful losses. Time for some secrets. Number 61. Most Wall Street analysts are terrible at predicting the market. Studies show that the average Wall Street forecast is wrong about 50% of the time, the same as flipping a coin. But analysts who predict doom get more media attention, so there's a built-in incentive to be pessimistic. Perverse incentives are Wall Street's specialty. Number 62. The January effect is the phenomenon where small-cap stocks tend to outperform in January. Why? Tax loss selling in December pushes prices down, and they rebound in January. Wall Street has known about this for decades, yet it still happens most years. Number 63. Wall Street firms pay premium prices for satellite imagery of parking lots, crop fields, and shipping ports. By counting cars at Walmart or monitoring Chinese factory output from space, hedge funds gain trading insights before official data is released. It's not insider trading if the information comes from outer space. Number 64. Some hedge funds track executive jet movements. If the CEO of Company A's jet is spotted at Company B's headquarters, it might mean a merger is coming. Services exist that monitor flight patterns of private jets. The rich get tracked so the other rich can trade on it. Number 65. The trading floor smells weird because of the stress. Hundreds of people in suits, making million-dollar decisions in a room with limited ventilation, creates a distinctive odor that former traders describe as a mix of coffee, sweat, and fear. Aromatherapy for capitalism. Number 66. Wall Street has its own funeral home, Reddens, which has handled the funerals of titans like J.P. Morgan. It's been serving the financial district since 1879. Even in death, Wall Street has its own services. Number 67. Traders have superstitions about specific stocks. Some refuse to trade stocks with certain ticker symbols. GE was considered cursed for years. Others believe round number prices, $10, $50, $100, are more likely to act as psychological barriers. Technical analysis is sometimes indistinguishable from astrology. Number 68. The most expensive seat ever sold on the NYSE went for $4 million in 2005, right before the exchange went public and seats became worthless. Timing is everything. Number 69. Warren Buffett has never bought or sold a stock through a smartphone app. He reads physical newspapers, drinks cherry coke, and makes billion-dollar decisions from an office in Omaha that looks like a dentist's waiting room. His net worth? Over $130 billion. Number 70. George Soros broke the Bank of England in 1992 by short-selling $10 billion worth of British pounds. He made approximately $1 billion in a single day when Britain was forced to withdraw from the European exchange rate mechanism. One person bet against an entire country's central bank and won. The regulations are interesting too. Number 71. The Volcker Rule, named after former Fed Chair Paul Volcker, was supposed to stop banks from gambling with depositors' money. It took 950 pages to write, years to implement, and has been weakened multiple times since. Banks have armies of lawyers dedicated solely to finding loopholes. Number 72. Insider trading is technically legal for members of Congress. The Stock Act of 2012 was supposed to ban it, but enforcement is essentially non-existent. Multiple members of both parties have been accused of suspicious trades before major legislation, and no one has gone to prison. Number 73. The SEC has a whistleblower program that pays up to 30% of sanctions collected over $1 million. The largest award ever? $279 million, paid in 2023 to a single whistleblower whose tip led to a successful enforcement action. Crime fighting is surprisingly lucrative. Number 74. The revolving door between Wall Street and Washington is well documented. Treasury secretaries frequently come from Goldman Sachs, including Robert Rubin, Henry Paulson, and Stephen Mnuchin. Regulators often leave to work for the firms they used to regulate. It's a small world with big conflicts. Number 75. Short selling, betting that stocks will fall, was temporarily banned during the 2008 crisis. The SEC thought it would stabilize markets. Studies later showed the ban had no positive effect and actually reduced market quality. Sometimes the cure is worse than the disease. Number 76. The Plunge Protection Team is real. Officially called the Working Group on Financial Markets, It was created after the 1987 crash and includes the Treasury Secretary, Fed Chair, and heads of the SEC and CFTC. Its purpose: coordinate responses to market emergencies. Critics say it secretly intervenes to prop up falling markets. Number 77. Circuit breakers, automatic trading halts when markets fall too fast, were implemented after 1987's Black Monday. If the S&P 500 falls 7%, trading stops for 15 minutes. Falls of 13% and 20% trigger longer halts. On the 9th of March 2020, circuit breakers tripped 4 times in 1 week. That was fun. Number 78. Naked short selling shares you haven't even borrowed, is supposed to be illegal but still happens. During the 2021 meme stock saga, evidence emerged that some hedge funds had sold more shares short than actually existed. The SEC investigated. Nothing happened. Number 79. The SEC once took 12 years to prosecute a case of insider trading, by which time the statute of limitations had almost expired and witnesses had died. Enforcement, when it happens, is glacially slow. Number 80. Financial regulators are massively outgunned. The SEC's annual budget is around $2 billion. The firms it regulates spend more than that on Christmas parties. Well, not quite, but close. Let's get personal. Number 81. The highest paid Wall Street employee in a single year was hedge fund manager John Paulson, who made $4.9 billion in 2010. That's approximately $13.4 million per day, $558,000 per hour, or $9,300 per minute. He made money betting against the housing market before the 2008 crash. Number 82. Renaissance Technologies Medallion Fund, run by mathematician Jim Simons, has averaged 66% annual returns before fees since 1988. It's the most successful hedge fund in history. How? Nobody outside the firm really knows. Simons employs mathematicians and physicists, not MBAs. He never explains his strategies. He passed away in May 2024. Number 83. Michael Burry, the guy from The Big Short who predicted the 2008 crisis, is an MD who taught himself finance. He has a glass eye, wears cargo shorts to work, and communicates with investors primarily through letter. He was considered insane for 2 years before being proven right. Number 84. Carl Icahn made his first Wall Street fortune by threatening to take over companies unless they paid him to go away, a practice called greenmail. It was legal. He's been called a corporate raider, an activist investor, and much worse. His net worth, approximately $6 billion. Number 85. The youngest person to run a Wall Street trading desk was reportedly 23 years old. The pressure caused him to develop ulcers by 25. Most traders burn out by their mid-30 seconds. It's not a career. It's a sprint. Number 86. Wall Street has a drug problem that nobody talks about. Cocaine was everywhere in the 1,980 seconds. Adderall and modafinil are everywhere now. Traders use stimulants to stay sharp during 14-hour days. Firms rarely test for drugs because they'd have to fire too many people. Number 87. Alcoholism on Wall Street is so common that major firms have unofficial policies about drinking at work. Some have bars on the trading floor. Aftermarket drinks are expected. Rehab is considered a temporary leave of absence, not a career ender. Number 88. The suicide rate among financial professionals is significantly higher than the national average. After the 2008 crisis, multiple executives and traders took their own lives. Mental health services exist but are stigmatized. The culture demands invincibility. Number 89. Wall Street has its own vocabulary for mental breakdowns. Going to the mattresses means hiding from work. Checking out means showing up but not functioning. Blowing your stack is losing it publicly on the trading floor. The culture creates casualties. Number 90. Some traders develop physical symptoms tied to market movements. Heart rate increases with volatility. Blood pressure spikes during earnings announcements. One study found that traders' cortisol levels on volatile days were comparable to soldiers under fire, almost there. Number 91. The phrase "too big to fail" was coined in 1984 when Continental Illinois National Bank was bailed out. The idea that some institutions are so important that the government must save them creates a perverse incentive. The bigger you are, the more risks you can take, because someone will catch you when you fall. Number 92. Only one top Wall Street executive went to prison for the 2008 financial crisis. Karim Serageldin from Credit Suisse, who was convicted of hiding losses. 0 executives from Lehman, Bear Stearns, AIG, Citigroup or Bank of America faced criminal charges. 0. Number 93. Iceland did the opposite. After their banks collapsed in 2008, Iceland prosecuted and jailed 26 bankers for financial crimes. Their economy recovered faster than most. It's almost like accountability works. Number 94. The average Wall Street bonus in 2021 was $257,500 on top of regular salary. That's more than most American households earn in 4 years. Bonuses are so important that traders' lives revolve around bonus season. Number 95. Goldman Sachs was nicknamed Government Sachs because so many of its alumni end up in government positions. The firm has also been called a great vampire squid wrapped around the face of humanity by Matt Taibbi in Rolling Stone. Goldman's PR department was not pleased. Number 96. Wall Street spends approximately $500 million per year lobbying Congress, more than any other industry except healthcare and real estate. The return on investment is excellent. Regulations are weakened, loopholes are created, and occasionally entire laws are written by industry lobbyists. Number 97. The 2010 Dodd-Frank Act was supposed to prevent another 2008 crisis. It was 2,300 pages long. Implementation required 390 separate rulemakings. Banks hired 30,000 compliance officers. The law has been weakened by every administration since its passage. Number 98. Cryptocurrency is now a Wall Street business. BlackRock, the world's largest asset manager, offers Bitcoin ETFs. Goldman Sachs has a crypto trading desk. The decentralized future looks a lot like the centralized past, but with more volatility. Number 99. In 2022, the crypto exchange FTX collapsed after it was revealed that founder Sam Bankman-Fried had misused billions in customer funds. He was convicted of fraud and money laundering in 2023. Before his arrest, he was worth $26 billion and was considered a financial genius. The cycle continues. Number 100. The New York Stock Exchange has been physically attacked multiple times. A bomb exploded outside the building on the 16th of September 1920, killing 38 people, the deadliest act of terrorism in American history at the time. The perpetrators were never caught. You can still see the shrapnel marks on the building's facade. Number 101. Wall Street's most famous saying, "buy low, sell high," is remarkably difficult to follow. Studies show that individual investors consistently do the opposite. They panic, sell during crashes and FOMO buy during bubbles. Wall Street's greatest secret isn't some hidden formula or insider knowledge. It's patience and the discipline to stick to a plan while everyone else loses their minds. And that's 101 facts about Wall Street, a place where fortunes are made, laws are bent, and the only thing more volatile than the market is the people who work there. If you enjoyed this, make sure to subscribe. And maybe don't take financial advice from a YouTube video.